I would summarize it almost like a year of integration. So we had 2022, which was of course a big shock year for commodities in general. This year we've kind of been rebalancing, figuring out what the new market is and introducing Midland, and a 3-year sustained OPEC cut that's just getting deeper and deeper. These are all kind of new things for the market. It's trying to figure itself out. Hi again, welcome to World of Oil Derivatives. I'm Greg Newman, the Chief Executive on Onyx Capital Group. Today is our last podcast of the year for research-focused podcasts, at least. I'm joined again with Vincent and Martha to discuss. Again, please remember to like and subscribe. It really does help the channel. And keep in touch because next year we're going to be evolving things, some interesting things on the horizon, and any feedback is always very welcome. Okay, guys, getting towards the end of the year, towards Christmas. Who wants to summarize?
Sure. So as you can see on my screen, Brent futures, there has been a consolidation in the higher 70s, around 77 to 78. Recent weakness from OPEC seems to be over, or let's just say the OPEC drama is over. Players seem to be genuinely happy with flat price at these levels, as they have been for most of the year, around 70 to 80. Brent spreads remain in contango until April/May 24. So market seems to be, the sentiment seems to be weak, but not so weak as well. There's been a lot of ups and downs in Brent this year, from a couple of regional banking crises from the start, to the surprise OPEC cut in April, to the market looking like it will be capitulating again, collapsing below 70, to extended Saudi Arabia voluntary cuts and continuous extensions of these prices going up to 95 and coming back down to the 70 to 80 levels. So it has been a roller coaster year for Brent futures. But overall, if you look at it from a even longer term perspective, prices at these levels seem to be more or less in line with the long-term average, and barring any significant headlines or news going into the end of the year, it doesn't seem like there will be a Santa Claus rally. The news there recently has been focused on the supply side disruptions around Red Sea, the attacks from the Houthi rebels. That's providing geopolitical risk premium once again, but otherwise seems to be a relatively quiet market going into year end.
So how would you kind of summarize the sentiment this year, Martha?
I think it's been a year of expectation with little to no reward. I think we had the beginning of the year, we had the China cheer, and everyone was just like obsessed with any bit of news coming out of China. We had such high hopes that did kind of become unfulfilled, a year of disappointment, but not disappointment for bulls that much. We didn't see any really significant, we didn't see prices down to 50, we didn't see prices up to 100. I think we saw the impact of Midland being added to the Brent basket. We saw the impact of larger volumes being less susceptible to like massive bull plays. I think that it was a pretty year.
It's a really interesting way of putting it. And I couldn't agree more, actually. A lot of expectations both ways. I think as we failed to rally significantly, we actually failed to sell off quite dramatically. I think whether that's a function of an elastic market, or whether or not that was a function of OPEC interventions, and people are starting to expect OPEC interventions, had that natural kind of floor to prices, and then also a ceiling to prices, being like the year before. If we weren't going to rally in Brent above 100 sustainably, why would we now? And that kind of kept us in a range there. And the Midland point is interesting as well, because no one was really very clear at all what the impact would be. But what we do know is that it's functioning very well. It's now integrated a very key structural physical flow into the futures market, which is exactly what you want from derivatives. You want them to reflect the physical market as much as it can, and it has definitely done that. Where the susceptibility to bull plays has happened, given the way it's structured, in a way, it's surprised me just how volatile it's been towards the upside. We've still had triple-digit backwardation in the physical differentials, even with Midland, which I've got to say is very surprising, but does kind of indicate, if there is more of a physical stream in the data Brent basket and there's still triple-digit physical premiums, then that's because there genuinely is physical differential premium. It's reflecting the physical market genuinely. So I guess it's more that we've had genuine strength. But we've also had pockets of weakness, which have failed to kind of follow through as well. So I think that's a great way of summarizing it, but it's not like it hasn't been interesting in between that,
No.
right? I mean, a lot has been going on with the refinery margins and how they've been balancing gasoil versus gasoline, the relationships, fuel, naphtha, they've been all over the place. I think is a fair thing to say. So I would summarize it almost like a year of integration. So we had 2022, which was of course a big shock year for commodities in general. And then this year we've kind of been rebalancing, figuring out what the new market is, and introducing Midland, and introducing, a foreign concept as well, which is like a 3-year sustained OPEC cut that's just getting deeper and deeper. These are all kind of new things for the market. It's trying to figure itself out. So I would conclude that by saying 2024, we actually are going into a year which is a bit more orderly, I would say, than we've had in a couple of years. All right, so do we want to talk about what's been going on with refined products?
Yeah, of course. So just as a special end of year special treat, we'll look at over the past week, and then we'll look at over the whole year and see what... There's been 4 quite distinct periods of change over the past year, so it's been quite easy to split up and talk about. But before that, over the past week, we've had quite unusual set of circumstances that we've not seen so much in the past couple of weeks, where we've had dated improving in price and all of the products improving in price, including quite a lot of support in EBOB and gasoil. So EBOB especially, we've seen good bidding over the week. So we've seen the support in crude being amplified in the products. So we've seen gasoil and EBOB improve, which we haven't seen in a while. EBOB has had good bidding over the week in the prompt, but trade houses have flipped from buying to selling in good size, and they continue to hold these. But we do continue to see good buying in the summer, with the forward curve kind of sandwiched between last year and the year previous. So I think that they're pretty happy to keep these levels in the crack. And looking at the RBOB smile graph for the volatility in the futures, week on week, there's more downside protection, but less upside protection. So it looks like there's no real impetus to volatility in the US gasoline futures. So that's what's been happening in gasoline over the week, in European gasoline. In gasoil, it's just been a supportive week. We saw a really big rally last week with the front spread up more than $1 on the day on the 13th. So a bit of support there that we've not seen for a while, which is a nice end of year. And then looking at the M1 refinery margin for Asia and Europe over the whole year, you can see they're all quite distinct in shape, and they were also quite distinct in what was happening at the time. So we'll just really quickly talk about what was happening at first. So at the very first section, between January and May, there was a pretty significant decrease, rally which was unsustained and then decrease. The rally was coming from the original support from the distillate ban and also from the French strikes. And then these both kind of fizzled out, had little effect, and there was support from the high stocks of both in Europe during the respective issues. And then in the second section here, it's pretty range bound. We had Brent in the low 70s, range bound, even with the cuts which were continuing. Gasoline was kind of lifting the margin, but with the levels in the US really low and the rubber hitting a 10-month high at the time. And then section 3, basically a rally across the board like we've seen this week: crude stronger, EBOB stronger, gasoil stronger. The barrels stuck in the east in gasoil, and the Rhine water level issues, which have started again at the end of the year, but on the flip side. And then this fourth section, this is where the gasoline complex collapsed, and we saw the really heavy sell-off in the RINs, which we covered quite a lot both in the podcast and other media, so do listen to that. And then lastly, we've seen the Middle East conflict, kind of a non-starter from that, and the Brent sell-off, the physical diff selling off, which meant that dated was less supported, and that's left the levels now lower than they started at the beginning of the year in Asia and Europe, M1 refinery margins.
Yeah, I think what's really clear with these two graphs, if you compare, say, the gasoil versus gasoline, people kind of used to call it gas to heat, as in gasoline versus heating oil, but this is European gasoline versus European gasoil, I'm assuming.
Yeah.
Again, it's widened out. Basically, gasoil, diesel is generally speaking been more expensive this year, as you would expect, than gasoline. They've been very tightly, they're the same price effectively during Q3. And if you look at the European versus Asian refinery margins, it's the same thing. I think that does make sense, just speaking with the kind of generic concept of European refineries are short gasoline. That's what they're trying to produce. They run light sweets. They don't produce much diesel, and then Asia do the reverse. So it does make sense, but it does also show you like how much gasoline's been such an important contract this year for refinery profitability, but also for making people's years. Like ultimately, Q3 gasoline strength and dated Brent strength has been a recurring theme over the last few years. It's become quite a reliable trade, I would argue, for the market, and it's performed once again. And then, yeah, as you say, like post that Q4, we've widened out again. Diesel is now more expensive than gasoline a fair bit, and that's reflected in now Asian refinery margins being that much stronger than Europe, because they do produce diesel or more diesel proportionally, and therefore generate more of a return on their margin. So that's kind of played out as we would kind of expect, but I think this is going to be exacerbated over the next few years. The refineries in Europe are not getting any more complex, and they're also not getting much investment because the renewable narrative, that kind of thing, the pressure on refineries to sell privately, which has been happening more and more. And every new refinery that's coming up in Asia is predominantly diesel generating focus. So we expect this kind of trend to kind of exacerbate. But then obviously how the trading flows react to it off the back of it will be seriously interesting as well. And we've got the Dangote refinery now, which was Nigeria key outlet for gasoline in Europe. That's now going to change next year. So I think there's going to be some interesting stuff. Next year we'll have a lot of new positioning, speculative wise, from the market, and there is a big proportion of the volume in the financial oil market dictated by trade houses and majors and hedge funds who hold for quite a significant period of time. They're looking to make a call based on 3 to 6 months a lot of the time, and sometimes even a year, and it will literally make or break their year whether that does transpire. So Vincent, what's the kind of trader positioning we're seeing so far?
Trader positioning, so looking at European gasoline, at the very least there has been a lot of speculative buy-side interest in the summer tenors, so that's from Q2 to Q3. So on the dashboard here, as was showing, we've identified, looking at the market trading split for Q2 for the summer tenors, market has been on the buy side and recently has been still getting longer as well. So that's the EBOB crack the benchmark for European gasoline.
I mean, this is why we designed the dashboard this way, right? It's super interesting for looking at positioning going forward, especially because what you can see in the middle of the graph is the open interest of the EBOB crack in this example, the summer tenors, that is quite low relative to what we expect, if we call it the ceiling. So that's the line at the top. So that's kind of generally what we'd expect over the last 5 years for the open interest to get to. So we're quite early on in that cycle, which is essentially saying that even if there is a very one-sided flow, which there is here, which is unsurprising, that people are buying into this summer trade once again, and they're doing it now, they can continue to buy. There's a lot more buying flows that can come in before we reach a kind of max risk capacity in the market. And that's what I think this really nicely shows. Like, you could look at it and say, especially in the last 7 days, very one-sided flow. For the lifetime of the contracts, the positioning is quite clearly long, and that might give a sense of saturation, but not at all, because if you look at how far the market can go in terms of taking buy-side flows, it can go a lot further. Having said all that, when you buy this early, you are in the trade until Q3 effectively, if you choose to be, and that's usually what these types of traders are doing. And there is a lot of volatility in between. So I think where this becomes interesting is that entry levels. So can you get up the entry levels for the same period? So if you look at the trader positioning levels, and we look at August, this is August, we can kind of see that the lifetime of people trading August tenor for the last 12 months, which you wouldn't expect to be too long. So a lot of it's probably concentrated in the last couple of months, you would think. The average price has roughly been for the buy side, which most people are buying, $11.26. And we know it gets up to $20, $30 per barrel gasolines on the more higher range in Q3. So you would think there's plenty of upside there. But we have actually, gasoline is a notoriously volatile contract. And gasoline versus Brent is as well. And so I guess the risk is you get in too early. Have you picked the right level? Because ultimately you've got to expect volatility. And I would imagine that people are saving their kind of capacity. They're like risk bullets for buying, levels below what it is right now. So I wouldn't look at these entry levels and say, right, every time we get to $11.26, we're going to see buying. You might see a bit, but I think it's more likely, given how we're quite early on in that risk cycle, that there'll probably be levels to buy at, like quite simple psychological levels, $10.50, $10, $9.50. But then what does tend to happen is if there is a big blowout, there is something that happens quite significantly next year. And for whatever reason, the gasoline crack goes to negative even, or very low. There will be a lot of people having to wear that, knowing or having a lot of confidence that it will retrace. But still, can you wear $7, $8 per barrel? That's still a lot of risk. So even though you want to position ahead of time, you also need to make the call that you're not going to be too susceptible to wild swings. And I think at $10 to $11 per barrel on Q3, you're probably thinking you're relatively safe. And I think if you actually look at the pricing historical charts, it would probably back that up, that you're in pretty safe territory. And of course, the other thing about Q3 gasoline is that you tend to get the potential upside from hurricanes, which can also shock to the upside. Okay, what other types of traded positioning is there for next year, Martha?
I think looking at the more prompt, the naphtha East-West, looking at MOPJ, the Asian naphtha versus NWE European naphtha, this has been blown out to really, really high levels. OI is extraordinarily high, above the level it usually is at settlement. And this is all based on the really high TC5 freight rate, which has been really expensive due to the previously mentioned maritime issues. So here, I think as soon as the freight rate starts to become less strong, we're going to see players kind of pile out of positions, and then a significant decrease in the naphtha East-West driven by MOPJ weakness.
If we compare what I was saying before and the East-West now, you can see the open interest is above the 5-year average and above the normal capacity we would expect the contract to hold by a fair margin. And this is for the January. Mm-hmm. This is for the January contract. So the market is now more significant what the market position is, and it's definitely net short, and the market's getting even shorter. So at these high levels, people are seemingly selling more into it, either not believing in it speculatively, or much more likely it's the physical optionality, right? You sell the East-West, you like the level, and if the price doesn't get lower, then ultimately you have the physical that you can actually move, and you can effectively convert that speculative position to a hedge. And this is the very enviable position physical traders have. They can sell this East-West contract, locking in Asia naphtha prices versus buying it in Europe and sending it over. And then worst case, the derivative price doesn't get lower, then they just have locked in quite an attractive level to move that physical. So just go on the entry levels quickly on that.
And I think it's worth bearing in mind that these are the players entering the East-West, whereas if prices are being driven up by MOPJ flat price, then this will be really attractive levels for people to short the East-West at, and that might not be moving price action, until it does.
It's a really good point. Ultimately, basically saying that this is our whole game, right? So there's so many different flows, and sometimes people forget that, the resulting price of differentials, time spreads, or any contract is accumulation of flows. It's not just one concentrated flow. So sometimes it's seemingly illogical moves. For example, this one, we have a lot of people selling in a market net selling. As we can see here, the shorts that have sold are out of the money. Their average price, they've kind of been selling all the way up. People who've been selling on the last 12 months are well out of the money. Where are we on the levels in the prompt?
Around 26 right now. Previously reached a ceiling of $30 per metric ton.
So starting to get quite volatile, as you can see. Yeah, that's definitely showing that there's a lot of interest at these levels continuously. And as you said, Martha, how can we be up at this level if there's been net selling in a contract? Well, it's because if you deconstruct the East-West, it's the trading in the East and the trading in the West, and the net has obviously been that there's been a lot more flat price buying, or outright contract buying in Asia would have been very likely driving things, and there's more to be said about that. But just going back to the trader positioning, ultimately, conversely to what we're saying about gasoline, it's getting to that stage where it is very important what's happening in the positioning, and given it's so close to the prompt, and given that the market is taking almost towards the maximum of its risk capacity, the shorts are in danger here, right? Either it comes lower and it's satisfied and whatever else, or if it's freight leading this, or whatever is leading it, if it continues to happen and it continues to be nonsensical for the physical traders, they could have sold too much relative to their physical optionality. They could be too speculatively invested, and you'll reach a certain level on the upside where they need to stop out. So these are the contracts that we like focusing on, because it should go either way. Do you join in on the sell side and believe what's happening, the trade houses and physical guys believe what's happening, or do you actually potentially structure a trade that it's a good risk reward, being like, if it does go higher, we could have a very fast acceleration higher as traders stop out, and actually towards the downside it might be a bit more orderly. So I would say almost like a liquidity trade, it's a good skew towards the upside. If you buy it, you'll probably be able to sell it on the way down, because you've got a lot of heavily short market that will be looking to take profit as you go down, and then you'll get liquidity that way. But on the upside, you've got no liquidity because everyone who could sell has already sold. So I think on that basis alone, it could be a buy. But having said that, I think, it's not that often that the market is so dramatically wrong with such a niche contract like this. But yeah, that's an interesting one. So that's NAPFA, and we kind of covered gasoline. What about fuel oil? Any positioning there in 2024?
Looking at fuel oil, yes. So fuel oil has actually been very much Brent driven recently. There's been had been a lot of uncertainty in the market before. It's worth mentioning that earlier this year with the OPEC cuts, one of the first major winners was actually Houthis fuel oil market, especially the 3.5 barge crack. Where it was actually pricing very, very close to flat $0 per barrel. Usually it's in the negative range. So it was particularly strong due to the supply tightness in the sour crude market. And we're still seeing a bit of buying flows as well. Usually the cracks move inverse against Brent. And as Brent became lower, we've been seeing more better buying flows in the cracks as well. So you can see in February, March, April, over the past week, there has been better buy side flows. Same for the summer cracks as well. And looking at the open interest, there is a lot of capacity to come back in. So that's
an interesting one. Fuel oil is going to be very interesting next year. As you said, I think the big win was the heavy sour market has been undeniably tight from a physical perspective. OPEC cutting, of course, and generally there being running out of supply. But when the Venezuelan news came out that there was some sanctions relief and some heavy sour crude coming from Venezuela being released, the fuel oil crack sold down $2 to $3. I was told. You get that graph up maybe for the next year's crack. So we did have this amazing rally, kind of logical rally, but if the argument is going to, this is why I love the refinery product margins, because people make a lot of claims about next year. And when I mentioned to OPEC when I was there that actually it looks like the heavy versus light sentiment is shifting for 2024, there's a bit of disbelief, like, nah, I don't actually think that's true. You got to tell people don't really think that to be true. Generally speaking in the market. But if you look at the forward curve, that's exactly what it's telling you. It's telling you that the fuel oil crack is down to more what we consider reasonable levels. I mean, the fuel oil crack has been minus 30 in 2019 when we had the IMO changes. But yeah, it can comfortably slit in the minus 20 to minus 15 range. So even at minus 11-ish or where we are now, that's still on the high side. So I think people expecting, if you say that it's so tight, well, then why is the fuel oil market, down to minus $11 per barrel when it has been flat? It's kind of giving the indication that the market isn't that worried. Refineries are hedging what they've got, and the fuel oil market has historically been the most actively hedged market. It's always been the biggest OTC market for swaps, and then when they became futures. So, our Mandara days, our Onyx, it all started from market making and fuel oil. It's a huge, huge, huge hedging market because it's a waste product. And when you get the chance to hedge it, managing a hedge, ironically, is like managing a loss here. It's no one wants to gamble that it's going to be profitable, obviously. So they need to manage losses as much as they're managing the upside. So it's always been a very hedged product. But what it's telling me, at least, it's sold off with the Venezuelan supply. It's come way back down to more normal, quotation marks, normal ranges. And then as we go into next year, you're looking at the Brent Dubai, the Cal 2024, that was deeply negative because of the OPEC situation. And we've gone back into backwardation there, and it's looking like it's going higher and higher. And it's a general bullish trend. And it's positive, which means light sweets, Western crudes are higher, more valuable than the heavy sours. So in combination, the forward curve doesn't lie. That's why I love it. And I think people should put it more into interpretation of supply and demand. At the end of the day, you can say what you want about heavy sours being tight and refineries, whatever. Just look at what's actually profitable, though, and what they will want to produce, and therefore what they will want to buy. If the fuel oil cracks were positive, you're going to buy a lot more heavy crude, and it's all going to be in demand, and it can justify a heavy crude rally. It can justify a negative Brent Dubai, but it's all changed now. You've had a big sell-off in gasoil, but much bigger sell-off in fuel oil. You've had rallies in gasoline. It's all much more balanced than it was at the beginning of the year or most of the year. And as I said, with the Brent Dubai as well. So it's just looking like I would say, historically normal market. In other words, we can actually see more light sweet demand relative to heavy than we've been seeing. And if anything, the oversupply will probably eat in from the heavier crude side more and more as we go, especially the people who are looking to come online more, like Brazil, like Venezuela, like Iran. Like, this is all coming, and it's all going to basically weigh on this heavy complex, if that all makes sense. Okay. And then what can we add on the crude side? Crude side, I think people are very bearish, is what I'm hearing. I think positioning is tentative, though, because we've had such a volatile year in the underlying contracts, the data Brent contracts, even the Brent spreads. It's been good for some, but I would say mostly bad in terms of managing the volatility. And so I think there's quite a lot of low confidence for next year. But it's not going to mean they're going to shy away. It's just needing to kind of calibrate. And I think risk reward heading towards the downside. So why don't we move to more short term? What's your trade idea for the week, guys?
Okay, so the trade of the week this week is to look at the WTI Brent diff, talking of crude, and looking at the levels it is at in the M2 versus historical levels for the past 5 years. We can see that it's pretty low. It's almost touching the 2019 value. It's dropped below the 2022 value in a time of year where, we're looking at leveling out, if not slightly improving. So seeing this significant decrease is quite unusual. So it looks like there could be good risk reward here, looking at that. And then also, as we've said, it's pretty bearish looking at the crude complex, worldwide. But looking at volatility skew for Brent initially, we can see that the put volatility is significantly higher than in the last week and the previous week before that, which suggests that players are more interested in protecting their downside. Therefore, they're expecting more downside because they are willing to pay more to protect against it. Although on the other hand, they have increased their call volatility too, but to a far less extent. And then looking at TI, there's a pretty unremarkable skew here as well. But we have seen the put volatility drop week on week. So it's interesting to see. I think that historically we're expecting levels to be higher, but also it's a pretty sad state of the market. I know Cushing being so full and there not really being a positive end of year demand story. But what do you guys think?
I think this... looking at the options and the fact that puts being more sought after makes a lot of sense. I think you want to hedge if you can, and maybe that does explain a bit of the downward volatility after the OPEC stuff earlier on. Ultimately, if you're not going to buy into the story of the upside and you're a producer, you got to hedge, right? I mean, that's logical. So I think you could probably argue that was responsible for a lot of it. And yeah, the skew being more towards the put side, i.e. hedging producer side than the consumer, I think is logical. But we did hear a bank being a trade idea, selling puts and buying calls, which is probably the most nuts trade that you could put on for next year. So it's basically selling puts gives you maximum downside to prices, Brent prices, and I think it was capping the upside because it was a call spread on the upside. So you've just basically trading the reverse of what the risk reward is in the market. So the risk is that it's heading downwards because it hasn't succeeded above 70, well, we're 77, 78 right now. It hasn't sustainably been above 80, 90 for very long at all, even in the war. Obviously we did get to above 100, but not for a huge amount of time. And so if it wasn't going to happen then, I don't see the risk reward happening it next year when we're much more balanced, if anything, oversupplied. So you want to be protecting yourself on the downside. And even if you're bullish, I would say buying puts and basically trying to play, using that as protection for trying to play the market on the long side, makes a lot more sense than the reverse. So that's what comes to mind when you say all that. I would, even though there's elevated levels on the puts versus to calls, sell what's high effectively, I think is what that message might be. It's just an incredibly risky proposition given what the outlet looks like. I mean, no one is convincingly bullish next year by their own admission. So that seems like an odd trade idea, but in general, that's all I've kind of really got to add to that. So that's kind of on an outright basis. But I see what you're saying about the comparing the Brent volatility, liquidity, and WTI, and then the outlook for that contract. That could get quite interesting, I can see, and that's what you're getting at, basically, right?
Yeah, and another thing to consider is looking at the correlation between the WTI Brent and the dated spreads. So if we get the screen up, this is really, really high at the moment due to the Midland setting the curve, and this is being so high. Looking at the dated spread then seems logical, and the dashboard for the DFL, which is dated minus Brent, shows that players are putting more length into these, which shows that they may be more keen to put some length in the dated spreads, keen to put some length into the TI Brent. It all gets a bit convoluted, but you can see that there could be some support coming into the TI Brent diff through that as well.
That is a good point. So the trade idea is WTI Brent essentially, and it's getting long.
Yeah, short-term length, seeing a bit of correction here.
It's worth mentioning that if we look at the CFTC COT positioning for WTI futures, it has been for a few months getting markets, money managers have been getting increasingly short, so much that the long to short ratio is one of the most shortest over the past decade, around like second or third percentile. So net positioning is very, very low, and as a result, the market is saturated towards the sell side. So should there be any bullish news whatsoever, then in the WTI market, the way it's positioned, it is very much vulnerable.
We've probably seen that in the last couple of days with the Red Sea, no?
It has been, yes, but we'll still be waiting to see how the CFTC data shows. But overall, even then, I still imagine the market will still be really, really short. So we're still waiting clarity for the new data, but I would say even despite the Red Sea, the market is still
short. Yeah, and I think it's remarkable. The managed money area of oil is remarkably resilient on the sell side, and I heard a bit of complaints about that. But what about the physical? And it's just logical. Like, if this isn't happening, if this isn't creating a bullish impact, financial traders have the luxury and the burden of looking at it purely numbers. They're looking at historical charting, they're looking at seasonality, they're just looking at what makes money on the trade. They're not biased about the physical underlying, or at least shouldn't. So I think that's really interesting, and it shows you the market evolution in its response to who's really driving prices. And people say it's OPEC, but then actually is it? Because this year it's stopped sell-offs, I think, the news of them cutting, but it's not halted them. So I think we continue to tread low, and I think that's coming through with the confidence in the managed money side of things. But they are fast money, like you say, and if there is big news and they are so saturated short, they will be the ones to react and cause volatility in the upside. So I can see that argument. It's quite a bullish thing to say the long short ratio is so low. I completely get that, and you can't discount it. The only thing I would add though is, but I would make the very speculative conclusion that the trade houses and majors, which have enormous risk capacity, have not yet utilized that risk capacity in the flat price as they usually would, in a kind of wait and see mode. So as they come in next year, they get more of an idea of what the physical really is going to do next year, and therefore what's going to dictate their view. That is how they work. Then it doesn't matter that these guys are so short, because if they come in and add a huge number of shorts as well, the price will definitely get lower from the sheer volume of sell side, and that needs to be absorbed. And if anything, as the price gets lower on that selling, the managed money could be using it to take profit, so it could rebalance the flows. So absent of that, it's a bullish factor. But I think if you like a supply and demand balance of the positioning, I think we haven't yet seen what the demand is going to be from the trade houses and majors buying or selling. And I think their material impact is so large once, and then once they get out, once they enter, once they get out, and that can be once a year, it can be twice a year. It's never very fast. So I think we just need to factor that all in. But look, some seriously interesting stuff there. And I think, I guess the best way to round this up is we've been trying this new format. I think after all the iterations of this podcast, we've really kind of found something we both like doing and getting great engagement from the wider audience on this podcast, focusing on the market week in, week out, and of course doing special episodes in and around of it. So we will continue this. And I think next year what we'll try to do is we're aware of the variance in the audience. You know, some people don't want generic oil analysis because you can kind of get that anywhere these days, and they want deep niche. But if you go deep niche, I don't think people are afraid of that who don't have a very good knowledge of oil, but they don't know the language. So I think we need to bridge that gap more next year. You know, for example, someone said, you know, what is EBOB, like EPOP, and they didn't understand. And that's completely, of course, why would you know a random word? You know, but it's European gasoline. So we just need to start bridging that gap in the language, so we can have these conversations, because I do think there should be an audience, even if you're not an oil trader, because it is so impactful to the wider world, wider macro world, financial world, and also the world in general. And with our information and with this deep kind of niche futures market, you know, the differentials, the time spreads, the product stuff, there's all these indications of what's going on in the world economy that just isn't being looked at. People just look at flat price or Brent futures price and say it's either healthy or it's unhealthy. But what about the east-west naphtha differential? That is showing you a difference in, you know, the underlying economic drivers, you know, the plastic demand, petrochemical demand. These are pretty serious things for the overall investing world that people should know about and should hear us discuss. But as I said, when we say MOPJ, okay, what we're talking about is Asian naphtha. So we need to describe that. So I think that's one thing I can kind of self-feedback to us. But if anyone's got any ideas or thoughts on it, please let us know. And, you know, hopefully we'll have some really, when I say bridging the gap towards the wider audiences, hopefully we'll have trading capacity to do that as well for the retail audience and investor audience in the long term too. You know, a bit of a hint, not very well disguised, but so please, as I said, any thoughts or discussion points, let us know. And you guys want to add as a sign off for the year? Have you enjoyed it?
Yeah, very much so. I've been enjoying doing these week in, week out, talking about the most interesting stuff in the market with you guys. And thank you to all of our viewers for your continued support. And I know my mum's always watching this as well.
Nice. Martha?
Thank you for watching and listening. Thank you, Greg, for having me. And
just a quick one, not to labor this point, but since when we had a different arrangement with the studio and a different kind of setup, like how have you noticed the difference?
I mean, it looks great.
It looks great. It looks very different, but I think the podcast style as well.
Yeah, having a bit of structure helps to not only prepare but also to listen to it, to know what's coming and to become a regular. I think that is really beneficial. Yeah, and we'll just try and work on, as I say, getting more and more feedback so we can bridge that gap and be like quite an effective podcast. Okay, I echo the sentiments of Vincent and Martha. Thank you everyone for listening. We've had a big uptick in our viewers and listeners, and it's really great to see, and it's really in line with what our company ethos is, you know, democratizing the energy and commodity space, and more education, more understanding, more transparency. And I know that will lead to more scale, and it's something we're very proud of at Onyx. So have a wonderful Christmas, happy holidays, happy New Year type stuff, and speak to you next year.